Welcome to Breaking News to Trading Moves. We're here to look at a pretty complex session. I mean, the overall market mood seemed upbeat, encouraging investors to take on more risk.
It did, but that's only half the story.
Right, because the actual flow of capital, where the money went, it revealed an incredibly strict, very targeted selection process.
That's the tension, and it's one you really need to grasp right now. U.S. stocks did see a recovery on Friday. That came after a pretty difficult prior day, and it was mostly driven by this growing idea that the Federal Reserve might, soften its stance sooner than we thought.
And that kind of sentiment tends to lift all boats.
It does. It creates what people call a generalized risk-on atmosphere.
And this is the key thing for your investing lens. That risk-on feeling was not indiscriminate. Not at all.
No. While money did flow back into equities, software investors in particular were operating with a scalpel. If companies' results were just fine, they were punished severely.
So the bar for execution is just exceptionally high. What we want to do today is cut through the noise, review 4 key stock movements, and really figure out what these very specific actions tell us about the broader investment categories you should be watching.
Okay, so we saw 4 stocks that really acted as perfect bellwethers for this whole dynamic.
Let's start with the ones that caught that optimism, the ones that saw the capital flow in.
At the top of that list was Cava. That's ticker CAVA. It surged approximately 12%.
And this wasn't on new results, was it?
No, not at all. This movement came from buyers finally stepping in after the stock had been, crushed, following some weak third-quarter results and a trimmed outlook.
Ah, okay.
So the discussion now is whether that first really severe sell-off was an overreaction, given Cava's long-term growth potential and, its brand strength.
So less about new information and more about the stock hitting what people felt was a valuation floor.
Exactly. Investors just decided the punishment exceeded the crime. Our second major mover to the upside was WillScot Holdings, ticker WSC. It climbed about 11%.
And what was behind that?
This one was directly triggered by an upgrade from Baird. They also raised their price target. And their whole thesis was explicit. WillScot benefits directly from a potential cyclical tailwind if interest rates start to ease.
Okay, so that's the positive side. Now let's pivot to the other side of the ledger, where that market strictness was really on full display.
The downside was all about software. Elastic, ticker ESTC, slid roughly 15%.
And the strange part here is that the company actually posted growth, right?
It did, but the market reacted viciously because cloud revenue growth decelerated. The bar for these high-multiple cloud businesses is just so unforgiving now that any slowdown, no matter how minor, just raises skepticism.
Skepticism about what specifically?
About how durable this AI-driven demand narrative really is and how much they can actually monetize it in the long run.
A 15% drop for deceleration, even while growing. That is a huge amount of punishment for what, in another environment would have been a solid report.
Yeah.
And we saw a similar theme with Veeva Systems.
We did. Veeva Systems, ticker VEEE, fell around 10%. And this is maybe the clearest example of this whole valuation reset theme.
What do you mean?
I mean, Veeva delivered solid growth, they beat estimates, and they even raised their guidance.
And it still fell 10%.
It still fell. This signals that investors are proactively trimming their exposure to these pricey, specialized health tech assets. The good news from inside the company just wasn't enough to fight the view that the valuation was just unsustainable.
Okay, so that lays it all out. You've got Cava and WillScot benefiting from these external factors, a valuation floor and rate speculation, while Elastic and Veeva got hammered because their execution just couldn't meet these almost impossible expectations.
Exactly.
So let's translate these individual moves into some broader categories, starting with the groups that were actually attracting capital.
Our first winning group is what we can call the beaten down fast casual rebound plays.
And we saw Cava, C-A-V-A, leading that charge. But what's the actual mechanism here driving the whole sector up?
The pop in Cava just confirms that capital is looking for quality growth stories that have been oversold. Simple as that.
So when the market flips to risk on,
that capital rotates very quickly into names that have suffered, high-profile setbacks but still have excellent long-term potential. It's an opportunistic trade. People are targeting a reversion to the mean for quality companies.
And the list of names that are benefiting from this investor appetite, it includes Cava, C-A-V-A, but also the big established leaders like Chipotle, ticker CMG, and of course Wingstop, W-I-N-G. They all share that high-growth, high-margin profile.
Absolutely. Now, the second group of beneficiaries is actually connected to Cava's recent struggles. the value and trade-down quick-service restaurants.
This is a really important distinction. Cava's guidance cut wasn't just about expansion plans. It was partly tied to real pressure on younger, more budget-conscious consumers.
And that's where the trade-down dynamic kicks in. When wallets tighten, people don't stop eating out. They just get much more rigorous about finding affordability.
So traffic rotates toward the value chain.
Exactly. It lets these affordable convenience players not just hold their ground, but often gain share from some of the slightly pricier, fast casual spots.
So we're seeing capital move into those players' best position to capture that traffic. That means giants like McDonald's, ticker MCD, Yum Brands, which is YUM, they own Taco Bell and KFC, and the Delivery King Domino's, DPZ.
Right. Now for the third category of winners, and this one is purely macroeconomic, the rate-sensitive cyclical services and rentals.
Okay, and this group is defined by that move we saw in WillScot Holdings, WSC. So let's get a bit deeper into that Baird upgrade. Why are these companies so sensitive to interest rates?
Well, it really comes down to the operational structure of the whole equipment rental industry. These companies, like WillScot, they run very capital-intensive businesses.
Right, they have to buy all that equipment.
They buy enormous amounts of mobile office units, construction equipment, all of it, and it's often financed with a lot of debt. So when markets start anticipating softer interest rates, even a small change, it really alters their profitability outlook.
So it's not just about optimism for future construction projects, it's the direct hit to their balance sheet and the cost of their fleet that drives the multiple expansion right away.
That's it. Lower financing costs, improve margins, they make big projects more viable, and that anticipation drives up expectations for WillScot, WSC, but also for leaders like United Rentals, URI, and Herc Holdings, HRI. They're basically leveraged bets on the macro forecast.
That gives us a really clear picture of where the money went. Now let's look at the punitive side of the market, focusing on these software groups where the performance bar is set at an almost impossible height.
The first group under pressure is what we can call AI-adjacent cloud software with not perfect reports.
With Elastic, ESTC as the main example, dropping 15% despite growth. We need to get inside the investor psychology on this.
The core issue is that Elastic and stocks like it aren't just priced for growth. They are priced for efficient, predictable, accelerating growth in cloud consumption that's tied to AI.
Okay.
So Elastic's slowdown, even a slight one, it signals two potential problems to the market. First, that economic uncertainty might be causing companies to pull back on cloud spending. And second, it raises doubt about how quickly that promised AI monetization is actually going to kick in.
And when those doubts pop up, investors who bought at those high valuations, they just de-risk instantly.
And it creates a spillover effect.
Right.
The sell-off in Elastic triggers fear that similar names like Snowflake, SNOW, or Datadog, DDOG, might also be vulnerable to the same issues.
All right, let's move to the second pressure point, the life sciences, tech, and services sector, which is facing some pretty intense valuation scrutiny.
Veeva Systems, VEEV, is the anchor here. And as we said, they beat estimates, they raised guidance, and the stock still fell 10%. It's not a problem with the company's execution, it's a re-rating.
Tell me more about that re-rating mechanism. Why is Veeva suddenly so vulnerable, even with good news?
Veeva's business is specialized cloud software for pharma and life sciences clients. It's mission-critical stuff like clinical trial management.
Okay.
During the pandemic, demand for these tools surged, and the market gave Veeva this astronomical valuation. Now, as the cost of capital is higher, investors are applying much stricter discount rates to those future earnings. The market is demanding that the price be justified by near-term profits, not just long-term dominance.
So even beating your quarter isn't good enough if your valuation requires you to be perfect for the next 3 years, and this pressure goes beyond just Veeva.
It does. It forces scrutiny on the whole ecosystem of specialized pharma IT, including names like IQVIA, IQV, and Certara, CERT. Their valuations also rely on that stable, high-margin revenue that now has to be stress-tested.
Which brings us to the third and maybe the most encompassing category of losers. High multiple growth stocks facing this generalized expectations risk.
Right. This ties together the lessons from both Elastic and Veeva. The theme is unmistakable. The market is acting like a brutal referee.
How so?
If a stock is priced for perfection, it requires blowout numbers. Every single quarter. Decent results, or even slightly good results, are now being treated as failures if they don't, propel the narrative forward.
It's that difference between a great business and a good stock price. The fundamentals at Elastic and Veeva were fine, but they weren't enough to satisfy the multiples they had.
Exactly. The risk premium for just meeting consensus is going up. And this dynamic weighs down any richly valued growth name after its earnings, even if it's not in cloud or life sciences. A name like ServiceNow, ticker NOW, constantly faces this, because the tiniest disappointment can trigger a wave of selling.
So if we pull this all together, we see a really clear contrast. On one side, you have these high growth expectations punishing even minor flaws in software, forcing these painful valuation resets.
And on the other side, you have capital actively rotating into value-oriented consumer plays or rate-sensitive cyclicals. It's a market that's deeply divided between a relentless demand for perfect growth and an opportunistic hunt for value.
The key takeaway for you is seeing just how sensitive those multiples are. When a business is high quality but extremely expensive, any small imperfection is used as grounds to reduce exposure. But let's leave you with one final thought to consider.
Looking back at those fast casual names that are seeing a rebound like Cava, you have to ask yourself, which ones are truly priced for a durable recovery that can withstand prolonged consumer stress? Versus which ones might quickly find themselves facing the exact same expectations risk as the cloud stocks if consumer pressure continues to squeeze the middle market. The challenge isn't just finding quality, it's figuring out which quality stocks still have room to run versus those that are already priced for everything to go right.
This is not financial advice or a recommendation to buy or sell any security. This is purely the opinion of the author.